I want to consider the market for health insurance and car insurance here. And there's a few terms that come up throughout macroeconomics and microeconomics, the insurance industry and finance in general. I just want to make sure we're kind of on the same page, and we've got a few examples to think through this. So first, just in the most simplistic case, what is an insurance policy? Well, this is something where you have some sort of coverage for issues that will happen down the road, either kind of catastrophic issues like you get in some sort of car accident and you need to have your engine replaced, or you need to have your front bumper put back on or rebuilt, for example, or you need to, in the health insurance market, this might be more chronic issues like you need to go to the doctor, or you have some sort of prescription drug that's expensive that you need to have covered. But it could also, in most of the time when we think about health insurance, particularly for relatively healthy individuals, this would be catastrophic issues where you have, maybe you've broken your arm or something like that, and you need to have that taken care of, and it would cost a good amount of money to go to the emergency room and have that taken care of. Health insurance in general, in car insurance, you typically will pay per month for coverage, and then you will have some sort of deductible. And that deductible, and I'll just write that here, deductible, this is how much you would have to cover. So you are going to pay your premiums per month, and then if something goes wrong, let's say you are in a car accident and your deductible is $500, you're going to have to pay the first $500 of that accident, and then everything over that $500 your car insurance company would cover. Basically the same holds true for health insurance. There's a lot of different ways that the deductible and the premiums can be set up, but just kind of a quick overview of what that looks like. So here let's jump in and think through a few different terms that come up and ways that people behave. The first one is moral hazard, and that is an increase in risky behavior as a result of not bearing the full costs of one's actions. And moral hazard is something, is often, it kind of comes up in the consideration of externalities in microeconomics. Here at moral hazard, we can think about in health insurance, well, this might be with moral hazard here, you might be more likely to go skiing, for example, if you know that you have health care coverage, because we know that skiing is a little more dangerous. You've got a higher probability of breaking an arm or a leg or something of that nature. And so maybe you take on a little more risky behavior than you otherwise would because you're covered for insurance. On the car market, what would that look like? Well, maybe you choose to drive a little faster. And your faster driving puts you in a little more risky behavior. It's one of those things where we can think about the full cost even as opportunity costs as well here. And it doesn't have to be just these two examples, but I'm just trying to think of a couple simple examples to think through what moral hazard would look like. Can also say in 2000, kind of systematically within the economy, we tended to see some moral hazard from the banking industry, in particular in the run-up to the financial crisis in 2007 and 2008. And how would that be the case for there to be moral hazard? In essence, you would have to say that there was some sort of insurance, that there was some sort of way that banks were not going to bear the full cost of their actions. And it is possible that would be the case because there's a lot of literature that kind of shows that there were individuals within the finance industry who believed that there were systematic issues, that in essence these banks were tied to each other, and that if one bank or financial institution was going to go under, such as a Lehman Brothers, that it might take other banks and might take other financial institutions under as well, like a Citigroup or a Goldman Sachs. If that's the case, then these individuals in the finance sector might believe that the federal government would step in and bail them out, or in essence, give them taxpayer monies to make them liquid, or to add liquidity to their balance sheet so that they do not go under or go bankrupt. That is something that we did a lot of in 2008, and one of the things that was being harped on was that this is creating moral hazard, that it is creating a situation where bankers will choose not to take into account the full cost of their actions because they think that the federal government will bail them out, that taxpayers will bail them out, and as a result, they are going to take more risky behaviors. It is probably true that some of this was going on in the marketplace. I wouldn't say that this was across the board, but there are definitely some banks where moral hazard was definitely was happening within the marketplace, and individuals were pursuing risky behavior where they didn't know the full cost of what they were doing, particularly that how systematically the financial institution was connected to itself, and so the failure of one would bring on the failure of many down the road as well. We tend to see that in the financial industry as well, and that's why you tend to see situations where a federal government will step in and do bailouts, because it is very risky. It is systemically risky for one bank to go under. So a little bit of a sidebar there, but we can see moral hazard in a number of different places. I'm going to go ahead and move on to adverse selection here, and that is when one's demand for insurance is positively correlated with their risk profile. And this risk profile is something that insurance companies care a lot about. They want to try to figure out how risky are you? What is the chance that you are going to have some sort of catastrophic illness, or that you are going to get into a car accident? And so they're going to ask you questions, like they're going to try to find out if you are male or female, for example. And there are certain questions in the health insurance and in car insurance where they can ask you that are legal questions, and then there are illegal questions because you really get into risk profiling. But what is it that they are trying to do, or what is it that's happening here? This is when one's demand for insurance is positively correlated with their risk profile. And so this might be an adverse selection in the health insurance industry, might be someone who smokes. And if someone smokes cigarettes, we know that they are more likely to have a number of health issues relatively immediately, and down the road long-term health issues that health insurance companies might not want to cover. And so they would want to try to figure out if you are a smoker. In fact, they ask that question: do you smoke cigarettes? There's a number of other ways that adverse selection can come in where you are just inherently a more risky person, and so you would more likely than others want to buy insurance. Now, on its own, you might be saying, well, that's kind of what insurance is for, so why should we care? Well, if one company has a very big risk pool, or has a risk pool of a bunch of individuals who are incredibly risky, or in essence have a very high likelihood of having big health insurance issues, that means that they're going to pay out a lot. And that can basically ruin a health insurance company. And so these are the types of things that come up all the time. In fact, adverse selection was something that came up a lot with the Affordable Care Act that was being discussed. And I've brought over a quick article here from Forbes. And I just did this because they were writing a ton of articles about this, and it was coming up a number of times. I don't necessarily think that this is something that we have seen so far in the data. Some of the state level data from the exchanges hasn't really been reported yet, but from the federal government side, it looks like we got a relatively good selection of, or kind of cross section of younger individuals and older individuals. And why do I say that we would care if they're younger or older? Well, that would be because we know that older individuals are more likely to have health issues. And so those are the type of individuals who we think would want to buy insurance. We also know kind of from history that healthy individuals, young individuals that are in college age or just out of college, tend to think that they're not going to have as many health issues. And they tend to think that because they're also right. They tend not to have as many health issues. The problem is when they do have health issues, they are big catastrophic issues like a broken leg or something of that nature, and it is expensive. And so this kind of terminology was being thrown around a lot, kind of particularly on the Republican side where they were saying, well, this is really going to cause an adverse selection. This death spiral kind of came up a lot. But what was it that they were saying? In essence, they needed young, healthy individuals who were not going to use the health care to get health insurance so that they could pay for it, so that they would pay into the system, and then the older, less healthy individuals would get the benefit of that, and it would underwrite the health insurance, it would underwrite the insurance companies. In essence, that we would have a larger risk pool and that it was more diversified. That's one of the issues that we see coming up all the time when we're looking at risk pools. For the Affordable Care Act, like I said, it looks like so far that hasn't been the case. That's not something that's been a huge issue. It looks like about 25 to 30% of the policies have been relatively young individuals who have a low likelihood of using the insurance in the short term or on a kind of high usage rate. All of this also brings up kind of this last point we'll just cover, which is asymmetric information. And this is basically the fact that in an insurance contract or in contracts in general, there are two parties or more, and that those parties in that transaction may have varying levels of information. We see asymmetric information in the finance industry all the time, where there are certain individuals who might know more about a stock or the performance of a business relative to other individuals in that marketplace. In the car insurance market, you might know a little more about your driving. Well, you do know a lot more about your driving habits than the car insurance company does. However, they're trying to get around that. I don't know if you've got car insurance companies like Progressive that have they have like a little box that plugs into your system, and their goal is to track some of the data on your driving patterns. And I think what they do is they give you a benefit, like they give you a cost discount if you are a kind of deemed as a safe driver. However, they're kind of doing the same type of thing where they're trying to get more information on you. On the health insurance market, there's asymmetric information all over the place where the insurance company does not know as much about kind of the underlying issues that you might have in your health. And then, like I said, you can think about this in the finance industry as well when it comes to businesses, when it comes to the stock market, when it comes to any number of financial transactions where the incentives of those that are lending and those that are borrowing are not always the exact same. So just a few examples and kind of some thinking through of moral hazard, adverse selection, asymmetric information in a few different cases where this comes up in finance and economics.